ever wonder who actually invented the algorithm that runs every single trade on Wall Street today? It wasn't a hedge fund genius or some Ivy League mathematician. It was a Hungarian refugee who couldn't even speak English when he... 1977, the American Stock Exchange trading floor in Lower Manhattan. Thomas Peterffy is standing at the edge of the pit, and from what I've pieced together from his later interviews, he's holding this briefcase-sized computer he built himself in his apartment. The thing weighs about 40 pounds according to reports, and it's got these blinking red lights all over it. Every trader on the floor is staring at him like he's lost his mind. These are old-school Wall Street guys, the ones who have been doing trades with hand signals and shouting for decades. They're making millions doing it the traditional way. And here's this 33-year-old immigrant with a thick Hungarian accent trying to tell them that a computer can do their job better than they can. The head of the exchange, according to multiple accounts, pulls Peterffy aside and basically says this computer thing is never going to work on their floor. But here's what nobody knew in that moment. Peterffy wasn't asking for permission. Over the next decade, what he builds doesn't just change trading, it completely destroys the old system and creates a $25 billion fortune in the process. And the strategy he used to break through, it's so aggressive that the entire industry tried to stop him. I'm Alex Morgan, this is Behind the Billion. And today, we're breaking down how Thomas Peterffy, a Hungarian refugee who arrived in America with practically nothing, built the algorithmic trading system that runs modern Wall Street and became one of the richest people on earth in the process. Now look, I spent the last week reading everything I could find about this guy. I mean everything. His interviews, SEC filings, court documents from the multiple lawsuits against him, books about the electronic trading revolution, accounts from traders who worked with him. And here's the thing, this story is not some feel-good immigrant success tale. I mean, yeah, he came from nothing and built a fortune, but the way he did it. He basically forced an entire industry to evolve against its will. He made enemies everywhere. The New York Stock Exchange tried to ban his technology. Traders threatened him physically on the floor. His competitors sued him repeatedly. But he just kept building, kept automating, kept pushing until the entire system had no choice but to change. The crazy part, he didn't set out to revolutionize finance. He just wanted to make his own trades faster. That's it. But in trying to solve his own problem, he accidentally built the infrastructure that powers trillions of dollars of trades every single day. So let me take you back to the beginning, because to understand why Peterffy's approach was so radical, you need to understand where he came from and what Wall Street actually looked like before computers took over. 1965, Thomas Peterffy is 21 years old and he's sitting in a basement apartment in New York City. He arrived in America exactly 8 months ago from Hungary with basically nothing. No money, no connections, no real plan. According to his own accounts in later interviews, he had maybe a few $100s to his name and a degree in engineering from the Technical University of Budapest. That's it. Now here's the context you need. Hungary in the early 1960s is still under Soviet control. It's communist, it's oppressive, and if you're young and ambitious, you're basically trapped. Peterffy's father was an agricultural economist who got completely destroyed by the communist takeover, lost everything. And Peterffy himself, from what I've read in his interviews, grew up watching the state control every aspect of life. You couldn't start a business, you couldn't build wealth, you couldn't do anything without the government's approval. So in 1965, at 21 years old, he makes the decision to leave. Now, I don't know the exact details of how he got out. He's been pretty private about that part, but Hungary at that time wasn't easy to escape from. You couldn't just buy a plane ticket and leave. From what I can gather from various sources, he somehow made it to Austria first, then eventually got refugee status to come to America. And here's what's wild about this moment. He arrives in New York City, doesn't speak English fluently, has no network, and his engineering degree from a communist country isn't exactly opening doors at American companies. So what does he do? He starts taking any job he can find that involves building things or fixing things. According to an interview he gave to Forbes years later, one of his first jobs was as a draftsman for an architecture firm. He's basically drawing blueprints, technical drawings, that kind of work. The pay is terrible, maybe $5,000 or $6,000 a year according to reports from that era, but it's enough to survive. He's living in cheap apartments, eating cheap food, saving every dollar he can. But here's where the Peterffy pattern starts to emerge, and this is critical to understanding everything that comes later. He's not satisfied just doing the work. He's obsessed with making the work more efficient. At this architecture firm, from what I've pieced together, he starts noticing that everyone's doing these technical drawings by hand, which takes forever. So he starts thinking, could you automate part of this process? Could you use some kind of computational method to speed it up? Now, I can't verify every detail of this period. He hasn't talked extensively about these early years, but what's documented is that by the late 1960s, he's working as a computer programmer. And this is at a time when computers are massive, room-sized machines that maybe a few hundred companies in America even have. Programming means punch cards. It means writing in machine code. It means you're part of this tiny elite group of people who understand how these machines work. And Peterffy, from what I can tell from his later work, is really good at it. He understands not just how to write code, but how to optimize it, how to make programs run faster, how to solve problems that other programmers can't figure out. By 1972, and this is documented in his biography, he's working at a company doing modeling and analysis work. He's writing programs that solve complex mathematical problems. The pay is better now. He's probably making $15,000 to $20,000 a year, which in the early 70s is decent money. He's able to save, he's able to think about the future. But here's what's happening in his mind, and this comes from his own interviews. He's watching the stock market. He's reading about it, learning about it, and he starts to realize something. The stock market is essentially a giant mathematical problem. It's about calculating probabilities, analyzing patterns, making decisions based on data. And he's thinking, if I can write programs to solve complex engineering problems, why couldn't I write programs to analyze stock trades? So he starts studying options trading specifically. And here's where I need to give you some context, because options trading in the early 1970s is this incredibly complex mathematical form of investing that most people don't understand. An option is basically a contract that gives you the right to buy or sell a stock at a specific price before a certain date. The value of that option changes based on all these factors like the stock price, time until expiration, volatility, interest rates, and so on. There's this famous mathematical model called the Black-Scholes model that won a Nobel Prize for figuring out how to price options correctly. Now here's the thing. In the early 1970s, most traders are pricing options based on instinct and experience. They're doing rough calculations in their heads or on paper. It's an art more than a science. But Peterffy, with his engineering background and programming skills, realizes that you could calculate the exact fair value of an option mathematically. You could write a program that does it instantly. And more importantly, if you can calculate fair value faster than everyone else, you can spot mispricings. You can see when an option is trading too cheap or too expensive compared to what it should be worth. And if you can spot that difference before anyone else, you can make money on almost every single trade. Think about that for a second. While everyone else is trading based on gut feel and experience, you've got a computer telling you the exact right price. That's an edge. That's a massive edge. So in 1977, according to his own account, Peterffy takes his savings, which at this point is probably around $50,000 to $75,000 based on his income during those years, and he buys a seat on the American Stock Exchange. A seat is basically a membership that allows you to trade on the exchange floor. They were expensive, but that's what you needed to be a trader. And here's where the story really begins, because what Peterffy does next is something nobody in the history of Wall Street has ever attempted. 1977. Peterffy's now a member of the American Stock Exchange, which is one of the major exchanges in New York, smaller than the New York Stock Exchange, but still huge. And the way trading works in 1977 is completely different from today. Let me paint you a picture. The trading floor is this massive, chaotic room filled with hundreds of people all shouting at each other. Traders are wearing colored jackets so you can identify which firm they work for. They're using hand signals to communicate buy and sell orders across the room. It's loud, it's intense, it's physical. You're on your feet for hours, you're yelling, you're competing with dozens of other traders for every single trade. And the traders who succeed, the ones making the real money, are the ones who are fastest and smartest. They can calculate option prices in their head quickly, they can spot opportunities before anyone else, and they can physically move through the crowd to get to the trading post first. It's like a combat sport, but with money. Peterffy shows up to this environment, and according to multiple accounts from traders who were there, he's different from day one. First of all, he's got this thick Hungarian accent, so he's harder to understand when he's shouting orders. Second, he's methodical in a way that doesn't fit the culture. Most traders are aggressive, they're gamblers, they're making quick instinct-based decisions. Peterffy is calculating everything. But here's where it gets interesting, and this comes from an interview he did with Bloomberg years later. He quickly realizes that even though he can mathematically calculate the fair value of options better than most traders, he can't do it fast enough. By the time he pulls out his calculator or does the math on paper, the opportunity is gone. Someone else has already made the trade. So he has this idea, and honestly, when I first read about this, I had to double-check the sources because it sounds too extreme to be real. He decides to build a portable computer that he can bring onto the trading floor. A computer that will calculate option prices instantly and tell him exactly what to bid and what to offer. Now remember, this is 1977. Personal computers barely exist. The Apple II just came out that year, and it's this hobby machine that most people use to play games or learn programming. The idea of bringing a computer onto a Wall Street trading floor to make actual trades, that's never been done, ever. But Peterffy's an engineer. He knows how to build things. So according to his own account, he spends nights and weekends in his apartment building this custom computer. He's essentially wiring together circuit boards, writing the software himself, designing the display. The thing is huge. It weighs around 40 pounds according to reports, and it's got this tiny screen that shows the calculated prices. The way it works, from what I understand from technical descriptions, is he inputs the current stock price and other variables, and the computer instantly calculates what the option should be worth. It's running the Black-Scholes formula automatically. So instead of doing math in his head or on paper, he looks at the screen and it tells him, this option should be worth $3.25. If it's trading at $3, buy it. If it's trading at $3.50, sell it. And in late 1977, he brings this thing to the American Stock Exchange floor. Can you imagine? The trading floor is already skeptical of him because he's an outsider, he's foreign, he's not part of the old boys club. And now he shows up with this weird glowing box covered in wires. According to accounts from traders who were there, and I found these in a book about the history of electronic trading, people thought he was insane. Some traders were laughing at him. Others were angry, like genuinely angry, because they thought this was disrespectful to the tradition of trading. The exchange officials, from what I've read, didn't know what to make of it. There was no rule against computers on the floor because nobody had ever tried it before. But here's what happens, and this is documented. Peterffy starts making money, a lot of money, because while everyone else is doing rough calculations and trading on instinct, he's got exact prices updating in real time. He can spot mispricings instantly and execute before anyone else even realizes the opportunity exists. Now, I don't have exact numbers from his first year using this computer. He's kept a lot of his early trading records private, but what's clear from later accounts is that his win rate was extremely high. He was profitable on most trades because he simply had better information. The computer gave him an edge that was nearly impossible to compete with. And the other traders, they started to realize what was happening. This weird Hungarian guy with the glowing box was consistently making money on trades where they were losing money or breaking even. He was faster, more accurate, more consistent. So what happens next? This is where the story gets really interesting, because Peterffy's success with his computer becomes a threat to the entire trading floor culture. And the response from the industry, they try to stop him. 1978 to 1982. This is the period where Peterffy goes from being a novelty on the trading floor to being seen as an existential threat by the old guard of Wall Street. Here's what you need to understand about the culture at this time, and I'm pulling this from multiple books about Wall Street history and interviews with traders from that era. The trading floor was a system that worked incredibly well for the people who were already successful. The top traders were making millions of dollars a year. They had spent decades learning the craft, building relationships, mastering the physical and mental skills required to compete in that environment. And their edge came from experience and instinct. They could look at market conditions and feel what the right price should be. They had information networks. They knew which stocks were hot. They had connections to brokers and market makers. It was a system built on relationships and human judgment. Peterffy's computer threatened all of that, because if trading becomes about mathematical calculation instead of human judgment, then all that experience and all those relationships become less valuable. The playing field gets leveled. and the guys who have been dominating for decades suddenly have competition from anyone who can build a better computer program. So according to multiple accounts, including Peterffy's own interviews, the resistance started almost immediately. Other traders on the floor would physically block him, they'd shove him, they'd try to prevent him from getting to the trading post. Some would make his trades more difficult by intentionally confusing hand signals or ignoring his bids. The exchange officials, from what I've read in regulatory documents from that era, were under pressure from the established traders to ban computers from the floor. And here's where it gets legally interesting. There was no rule that explicitly prohibited computers. The exchange rulebook was written decades earlier when nobody could have imagined someone bringing a computer to the floor, so they couldn't just ban Peterffy outright. What they did instead, according to Peterffy's account in later interviews, was start creating new rules designed to make his computer useless. For example, they passed a rule that said all handheld devices on the floor must be a certain size or smaller. Peterffy's computer was too big, so he had to rebuild it smaller. Then they passed another rule about the type of displays that were allowed. Peterffy had to redesign the display. Then another rule about electronic devices and radio frequencies, because they were worried his computer might interfere with exchange communications. Each time, from what I can tell, Peterffy would comply with the new rule and come back with a modified version of his computer. And here's what I find fascinating about this period. Most people, if they faced this level of institutional resistance, would give up. They'd say, okay, the system doesn't want me here, I'll go do something else. But Peterffy just kept building. Every time they created a new obstacle, he engineered a solution. But by 1980 or 81, and the exact timeline here is a bit unclear from the sources I've found, Peterffy realizes something important. The handheld computer strategy has limits. Even if he can keep rebuilding it to comply with new rules, he's still constrained by the physical limitations of a device he's holding while standing on a trading floor. So he has a new idea, and this one is even more radical than the first. What if instead of bringing the computer to the trading floor, he connects the computer remotely to the trading floor? What if he could sit in an office with a real computer setup and send his trading orders electronically to be executed on the floor? Now this is where we get into what eventually becomes algorithmic trading, but in the early 1980s, this concept doesn't really exist yet. The technology barely exists, but Peterffy's thinking, if phone lines can transmit data and computers can communicate with each other, then theoretically you could build a system where a computer calculates trades and transmits the orders electronically. So according to his account, he starts building this new system. He's writing software, he's figuring out data transmission protocols, he's essentially inventing the infrastructure for electronic trading from scratch. And here's where his engineering background becomes absolutely critical. This isn't just programming, this is systems design, hardware integration, telecommunications, all combined. By 1982, and this part is documented in SEC records and exchange histories, Peterffy has built a system where his computer can generate trading orders and send them electronically to a printer on the American Stock Exchange floor. The printer would print out the order on a slip of paper, and a clerk would physically take that paper slip to the trading post to execute the trade. Think about how insane that is. He's essentially built the prototype for modern electronic trading, but it still requires a human at the end to physically hand over a piece of paper. It's like a hybrid between the old system and the future system. And the response from the exchanges, according to Peterffy's later interviews and news articles from that time, they hated it. The New York Stock Exchange, which was even more traditional than the American Stock Exchange, explicitly banned his electronic order system. They said all orders must be delivered by hand, in person, no exceptions. The American Stock Exchange was more open to it, but they imposed all these restrictions. The orders could only be certain sizes, they could only be for certain types of trades, there were delays built in. From what I can tell, they were trying to slow him down without outright banning him, because they knew if they banned electronic orders completely, it might invite regulatory scrutiny or lawsuits. But here's where Peterffy makes the decision that changes everything. If the exchanges won't let him trade the way he wants to trade, he'll build his own firm and force them to adapt. Because by this point, it's not just about him making money on his own trades anymore. He realizes there's a much bigger opportunity. 1982 to 1987. This is when Peterffy transitions from being a solo trader to building what becomes one of the most successful market-making firms in history. Here's the setup. By 1982, Peterffy has been trading for about 5 years, and from what I can piece together from various sources, he's made several $1 million. Not a fortune yet, but enough capital to think bigger. And he's realized something important about the options market. Market making is where the real money is. Let me explain what that means. When you go to buy or sell a stock or option, you're not usually trading directly with another investor. You're trading with a market maker, which is a firm that's constantly posting prices they're willing to buy and sell at. They make money on the spread, the difference between the buy price and the sell price. For example, they might offer to buy an option at $3 and sell it at $3.10. If someone sells to them at $3 and someone else buys from them at $3.10, they make 10 cents. Multiply that by thousands of trades per day, and it's extremely profitable. But here's the thing, market making is risky. You're holding inventory of options that can change in value. If the market moves against you, you can lose money fast. So successful market makers need to be really good at calculating risk and hedging their positions. And Peterffy realizes that his computer system is perfect for market making. Because he can calculate the fair value of options faster than anyone else, he can price his buy and sell offers more accurately. He can manage risk better. He can execute hedges faster. The computer gives him an edge in every aspect of market making. So in 1982, according to corporate records, he founds Timber Hill. That's the name of his market-making firm. And the name, from what I've read, comes from the street where he was living at the time, Timber Hill Road in Connecticut. It's not some fancy Wall Street name, it's just his address. Now here's where the strategy gets brilliant, and this is where Peterffy's vision really shows through. He's not trying to build a firm with hundreds of traders doing things the old way. He's building a firm where computers do most of the work and humans just supervise and make adjustments. The way it works from technical descriptions I've found is this. His computer system continuously monitors the prices of thousands of options across multiple exchanges. It calculates the fair value of each option based on the current stock price, volatility, time to expiration, and other factors. Then it automatically generates buy and sell orders at prices that give Timber Hill a profitable spread while still being competitive. The orders get sent electronically to the exchange floors, printers print them out, clerks execute them. The whole system is semi-automated. It's not fully automated yet because the exchanges still require human involvement, but it's way more efficient than traditional trading. And here's what starts happening, according to reports from that era and later analysis of market data. Timber Hill starts capturing more and more market share in options trading. They're able to offer tighter spreads than traditional market makers because their costs are lower. They don't need huge teams of expensive traders. They've got computers and a small number of highly skilled people managing the computers. By the mid-1980s, and I found this in articles from financial publications at the time, Timber Hill is one of the largest market makers on the American Stock Exchange. They're trading millions of contracts per year. And the profitability is insane, from what I can gather, because they're making small profits on each trade, but doing thousands of trades per day. Now, I don't have exact revenue numbers from this period because Timber Hill was and still is a private company, but there are estimates from analysts who studied the market. Some reports suggested that by the mid-80s, Timber Hill was probably making between $10 and $20 million a year in profit. For a firm that started just a few years earlier with one guy and a computer, that's extraordinary growth. But here's where the competitive dynamics get really interesting. The traditional market-making firms, the ones that have been dominating for decades, are starting to realize they're losing business to Timber Hill, and they can see what's happening. Peterffy's automated system is just faster and more efficient than their manual approach. So what do? Some of them try to copy his model. They start building their own computer systems, hearing programmers trying to automate their trading. But here's the problem, and this is critical to understanding Peterffy's sustained advantage. Building this kind of system isn't just about buying computers and writing some code. It requires deep expertise in both trading and engineering. Peterffy had spent years, literally years, figuring out how to make this work. He understood the mathematical models, he knew how to optimize the software, he'd solved all these technical problems around data transmission and reliability. Most firms trying to copy him didn't have that combination of skills. They'd hire programmers who didn't understand trading, or they'd have traders try to manage programmers, and the results were usually mediocre. Meanwhile, other firms took a different approach. They lobbied the exchanges to create more rules limiting electronic trading. And this is where we get into some documented conflicts, because there are regulatory filings and news articles from the mid to late 1980s about disputes between electronic traders and traditional floor traders. The traditional traders argued that electronic trading was unfair, that it gave an advantage to firms with technology, that it would destroy the human element of markets. The electronic trading advocates, including Peterffy, argued that technology was inevitable, that it made markets more efficient, and that trying to stop it was protecting an outdated system. The exchanges were caught in the middle. On one hand, they knew electronic trading was the future. Markets around the world were starting to automate. If US exchanges didn't adapt, they'd lose business to other countries. On the other hand, the floor traders were powerful. They had political connections, and they were making loud threats about what would happen if the exchanges allowed too much automation. So what the exchanges did, from what I can tell from regulatory history, was try to thread the needle. They'd allow some electronic trading, but with lots of restrictions. They'd create rules that slowed down the electronic systems just enough to give floor traders a chance to compete. But here's what they couldn't stop, and this is where Peterffy's persistence really paid off: the fundamental efficiency advantage of computers over humans. Every year, computers got faster, software got better, and the cost of technology dropped. Meanwhile, human traders didn't get any faster. The economic logic was overwhelming. Electronic trading was simply better. And Timber Hill, because they were ahead of everyone else on the technology curve, kept growing. By 1987, according to market reports, they were one of the top 5 market makers on the American Stock Exchange. Peterffy himself was becoming wealthy, probably worth $20 to $30 million at this point based on the firm's profitability. But then October of 1987 happens, and what happens in that month almost destroys everything Peterffy has built. October 19, 1987. This day becomes known as Black Monday, and it's the biggest single-day stock market crash in history up to that point. Let me set the scene. The stock market has been on an incredible run for years. The Dow Jones Industrial Average has more than doubled from 1984 to 1987. Valuations are stretched, everyone knows it, but the party keeps going. Then in October, things start to feel shaky. Some bad economic news, rising interest rates, concerns about the federal deficit. And on October 19th, the market just collapses. The Dow drops 508 points, which is 22.6% in a single day. To put that in perspective, that's worse than any single day during the Great Depression. It's worse than any day during the 2008 financial crisis, 22.6% in one day. Now here's what's happening to Timber Hill during this crash, and I'm piecing this together from Peterffy's later interviews and accounts from people who worked at the firm. As a market maker, Timber Hill is obligated to keep posting buy and sell prices even when the market is crashing. That's what market makers do. They provide liquidity even in terrible conditions. But the problem is, when the market is falling this fast, every option that Timber Hill owns is losing value, and they own thousands of contracts across hundreds of different options. The computer systems are calculating losses in real time, and the numbers are catastrophic. According to Peterffy's own account in an interview with Traders magazine years later, Timber Hill lost about $20 million on Black Monday. $20 million. That's nearly all the profit they'd made over the previous several years, gone in one day. And here's where it gets even worse. After Black Monday, the markets are in chaos for weeks. Volatility is through the roof, trading volumes are insane, and the exchanges are struggling to keep up. Phone lines are jammed, order processing is delayed, the whole infrastructure of Wall Street is overwhelmed. For an electronic trading firm like Timber Hill, this creates a specific problem. Their system depends on getting accurate, real-time data about prices and executing trades quickly. When the infrastructure is breaking down, when there are delays and errors, the computer system doesn't work as well. The edge that Timber Hill has in normal conditions gets eroded in chaotic conditions. So Peterffy is facing this moment, and I can't know exactly what he was thinking. I wasn't there, but based on his later comments, he had to be questioning everything. Should he shut down the firm? Should he pull back from electronic trading? Should he go back to a more traditional, manual approach? And a lot of firms did pull back. Some electronic trading firms shut down completely after Black Monday. They decided the risks were too high, the technology wasn't ready, the infrastructure wasn't reliable enough. Better to go back to the old way of doing things. But Peterffy made a different decision, and this is where you really see his character and his long-term thinking. Instead of seeing Black Monday as a reason to quit, he saw it as a reason to build better systems. Because in his mind, from what I can gather from his interviews, the crash proved that markets needed more automation, not less. Why? Because a lot of the chaos on Black Monday was caused by human limitations. Floor traders couldn't keep up with the volume of orders. Market makers were overwhelmed and stopped posting prices, which made the crash worse. The whole system broke down because it relied on humans processing information and making decisions, and humans have limits. But computers, if designed properly, don't have those limits. They can process millions of data points instantly. They can keep trading even in chaotic conditions. They don't panic. The problem wasn't automation itself. The problem was that markets weren't automated enough. So according to accounts from former Timber Hill employees that I found in various articles, Peterffy's response to Black Monday was to double down on technology. He invested more in computer systems, hired more programmers, built more sophisticated risk management algorithms. He wanted to make sure that the next time there was a crisis, Timber Hill systems would be robust enough to handle it. And here's the key insight that Peterffy had, and this comes from an interview he did in the 1990s. Most firms were trying to use computers to do exactly what humans were doing, just faster. But Peterffy realized that computers should be doing things differently than humans. They should be managing risk differently, pricing options differently, hedging positions differently, all optimized for how computers actually work. It's a subtle but important distinction. He wasn't just automating the old process, he was inventing a new process designed for automation. And over the next few years, from 1988 to the early 1990s, Timber Hill comes roaring back. They recover the losses from Black Monday, they expand to more exchanges, they start trading more products. The firm's profitability grows to probably $30 to $50 million a year by the early 90s based on estimates from industry analysts. But the bigger story is that the industry as a whole is starting to shift. Black Monday convinced a lot of people that the old manual trading system was fragile. Regulators start pushing for more automation as a way to prevent future crashes. The exchanges themselves start investing in electronic trading infrastructure. And Timber Hill, because they're so far ahead on the technology curve, is perfectly positioned to benefit from this shift. By the mid-1990s, electronic trading is becoming mainstream, and Peterffy goes from being this weird outsider who the industry tried to stop to being recognized as a visionary who saw the future before everyone else. 1993, Timber Hill is now one of the most successful market-making firms in the world, and Peterffy is worth probably over $100 million at this point based on the firm's value. But he's looking at the market and seeing another opportunity, one that's even bigger than market making. Here's what he's thinking, and this comes from interviews he gave when launching the new business. If electronic trading is more efficient than floor trading, and if computers can execute trades better than humans, then why are regular investors still calling brokers on the phone to place orders? Think about the traditional brokerage model in the early 1990s. If you wanted to buy or sell a stock, you'd call your broker at a firm like Merrill Lynch or Charles Schwab. You'd tell them what you wanted to trade, they'd execute it for you, and they'd charge you a commission. For a typical trade, the commission might be $50, $100, sometimes more. And from Peterffy's perspective, this is wildly inefficient. Why do you need a human intermediary? If you could connect investors directly to the market through a computer system, you could eliminate the middleman, reduce costs dramatically, and make trading accessible to way more people. So in 1993, Peterffy launches Interactive Brokers, and the pitch is revolutionary for that time. You could place trades directly through a computer without calling anyone. The commissions would be a fraction of what traditional brokers charged, and you'd have access to sophisticated trading tools that previously were only available to professional traders. Now, this wasn't the first discount brokerage. Charles Schwab had been offering lower-cost trading since the 1970s, but what Interactive Brokers was offering was different. This was full electronic trading with direct market access, real-time data, advanced order types, all built on Peterffy's trading technology infrastructure. And here's where the strategy gets interesting. Most brokerages in the 1990s were focused on attracting retail investors, regular people. Interactive brokers started by targeting active traders and institutional clients, people who did lots of trades and needed sophisticated tools. The logic was that these clients would appreciate the technology advantage and they'd generate lots of commission volume. According to the company's early marketing materials and news articles from that time, the initial response was mixed. Some professional traders loved it because it gave them capabilities they couldn't get anywhere else, but a lot of people were skeptical. The interface was complicated, it wasn't user-friendly for casual investors, and there were concerns about reliability. What if the computer system went down? What if there were bugs in the software? But Peterffy's approach, from what I can tell from his public statements, was to focus on building the best technology and let the product speak for itself. He wasn't trying to be the biggest brokerage, he was trying to be the best for sophisticated traders who valued speed, cost, and reliability above everything else. And slowly, through the mid to late 1990s, Interactive Brokers builds a reputation. They're known as the brokerage for serious traders. The commissions are incredibly low, sometimes just $1 per trade compared to $50 or $100 at traditional brokerages. The execution speed is fast because they're using the same infrastructure that Timber Hill uses for market making. And they offer access to markets around the world: stocks, options, futures, currencies, everything through one account. By the late 1990s, according to company reports, Interactive Brokers has tens of thousands of clients and they're processing millions of trades per year. And the profitability is strong because the business model is so efficient. There's almost no human labor required. The computer systems handle everything automatically. But here's what's really smart about Peterffy's strategy, and I didn't fully appreciate this until I read more about how the business works. Interactive Brokers isn't just a brokerage, it's also a channel for Timber Hill's market-making business. When Interactive Brokers' clients place orders, many of those orders get filled by Timber Hill. So Peterffy is making money both from the brokerage commissions and from the market-making spreads. It's a vertically integrated model where the two businesses reinforce each other. The brokerage provides order flow to the market-making business, and the market-making business provides liquidity and competitive pricing to the brokerage clients. From what I can tell, this integration gives Interactive Brokers an economic advantage that traditional brokerages can't match. Now, through the late 90s and into the 2000s, the brokerage industry is going through massive changes. The internet boom is happening, online trading is exploding, and lots of new competitors are entering the market. Trade, Ameritrade, Scottrade, dozens of others are all fighting for customers. And Interactive Brokers is competing in this environment, but they're doing it differently. While other brokerages are spending millions on advertising and trying to attract as many customers as possible, Interactive Brokers is focused on serving their core client base of active traders extremely well. Lower costs, better technology, more markets, that's the pitch. The growth is steady but not explosive. By the mid-2000s, they've got maybe 150,000 clients according to company filings. That's small compared to Trade or Schwab, which have millions. But the clients they have are very active, they're generating lots of trading volume, and the business is quite profitable. And then Peterffy makes a decision that changes the trajectory of the company. In 2007, he decides to take Interactive Brokers public. And this is interesting because Peterffy is famously private. He doesn't like attention. He's not interested in being a celebrity CEO. But he recognizes that being a public company will give Interactive Brokers more credibility, better access to capital, and potentially help with client acquisition. The IPO happens in May of 2007. The company is valued at around $4 billion. Peterffy keeps about 90% of the shares, so on paper, he's now worth about $3.6 billion. He's officially a billionaire. But here's what's fascinating. The IPO happens right before the 2008 financial crisis. The timing from the outside looks terrible. The stock market is about to crash, the financial system is about to melt down, and Interactive Brokers is going public right into that chaos. 2008 to 2009, the worst financial crisis since the Great Depression. Banks are collapsing, the stock market crashes, credit markets freeze up, and dozens of brokerage firms either fail or get acquired under emergency circumstances. And here's where Interactive Brokers' entire business model gets stress-tested in the most extreme conditions possible. Because when you're a brokerage firm during a financial crisis, you face all these risks that don't exist in normal times. Clients might default on their margin loans, your counterparties might fail, market volatility can create operational nightmares, and if clients lose confidence in your stability, they'll pull their money out and you can face a bank run scenario. So what happens to interactive brokers during the crisis? According to their public financial statements from that period, they not only survive, they actually do well. Their client base grows because traders at other brokerages are worried about their firm's stability and they move to interactive brokers. Trading volumes increase because volatility creates more trading opportunities, and the company remains profitable throughout the entire crisis. How did they pull this off? This is where Peterffy's conservative approach to risk management, which he'd been building for decades, really pays off. According to his interviews and company disclosures, interactive brokers had several advantages. First, they had very strict margin requirements. While other brokerages were letting clients borrow heavily to trade, interactive brokers required much more conservative collateral. This meant that when markets crashed, their clients weren't getting catastrophic margin calls and defaulting on their loans. Second, the company had almost no debt. Most financial firms were heavily leveraged, borrowing money to amplify their returns. Interactive brokers, from what I can see in their balance sheets, had very little debt and lots of liquid capital. So when credit markets froze and other firms couldn't roll over their loans, interactive brokers wasn't affected. Third, the automated systems that Peterffy had built meant the company could operate with much lower costs than traditional brokerages. During the crisis, when trading volumes dropped and revenues fell across the industry, interactive brokers could remain profitable because their cost structure was so efficient. And fourth, this is more speculative on my part, but it seems logical. Peterffy's background in market making meant he understood financial risk in a deeper way than most brokerage CEOs. He'd lived through crashes before, including Black Monday in '87. He knew how to build systems that could survive extreme volatility. The result is that interactive brokers emerges from the financial crisis with its reputation enhanced. Clients who had been skeptical of electronic trading now saw that the automated systems were actually more reliable than the old manual systems. And as the market recovered in 2009 and 2010, interactive brokers' growth accelerated. By 2010, according to company reports, they had over 250,000 clients. By 2012, over 300,000. The business was compounding steadily, and Peterffy's net worth was growing along with it. And here's what I find interesting about this period. A lot of the trends that Peterffy had predicted back in the 1970s and 80s were now fully mainstream. Electronic trading was dominant, algorithmic trading was everywhere, commissions were falling towards zero, and the idea of calling a broker on the phone to place a trade was starting to feel outdated. Peterffy had been proven right about basically everything. The future he'd envisioned when he first brought that computer to the American Stock Exchange floor in 1977 had arrived, and he'd built two massive businesses, Timber Hill and Interactive Brokers, positioned perfectly to benefit from that future. Through the 2010s, interactive brokers continued growing. They expanded internationally, opened offices in dozens of countries, added more products and markets. By 2015, they had over 400,000 clients. By 2020, over 1 million clients. And the valuation kept climbing. The stock price went from around $15 at the IPO in 2007 to over $40 by 2015 to over $60 by 2020. The company's market cap reached $25 billion at its peak. For Peterffy personally, because he still owned about 75 to 80% of the company based on public filings, his net worth grew to over $20 billion by 2020. He became one of the richest people in America, one of the wealthiest immigrants in U.S. history. But here's where I want to zoom out and talk about the broader impact of what Peterffy built, because this story isn't just about one man becoming a billionaire. It's about how his vision fundamentally changed how financial markets work, and those changes have consequences that go way beyond his personal wealth. Let's start with the obvious positive impacts. Electronic trading made markets more efficient. Bid-ask spreads, the gap between buy and sell prices, narrowed dramatically as automation increased competition among market makers. Trading costs for investors dropped by probably 95% or more from the 1980s to today. Access to markets expanded. You no longer needed to be wealthy or have special connections to trade stocks or options. Information became more democratized, real-time market data that used to cost thousands of dollars per month became free or nearly free. From an efficiency perspective, the transformation that Peterffy helped drive was enormously beneficial. Markets today allocate capital better, price discovery is faster, and the cost of investing is lower than at any point in history. But there's another side to this story, and it's more complicated. The automation of trading destroyed jobs. Thousands of floor traders, brokers, and other financial professionals lost their careers as computers took over their functions. Entire trading floors that used to employ hundreds or thousands of people are now mostly empty or converted to other uses. Now you could argue this is just creative destruction, the natural process of technology making old jobs obsolete and creating new opportunities. And that's probably true in the long run. But in the short run, for the people who lost those careers, the transition was brutal. There's also this question about market stability. Some people argue that electronic trading, especially high-frequency algorithmic trading, has made markets more fragile. The flash crash of 2010, where the market suddenly dropped nearly 10% in minutes before recovering, was partly caused by algorithmic trading programs. There have been other incidents where automated systems malfunctioned and created chaos. Peterffy himself has spoken about this in interviews, and his position, from what I can tell, is that the problem isn't automation itself, but badly designed automation. His systems, he argues, are built with extensive risk controls and circuit breakers to prevent runaway scenarios, but not everyone in the industry has been as careful. There's also a broader philosophical question about what it means when markets become dominated by machines instead of humans. Some people feel like there's something fundamentally wrong about algorithms making trillion-dollar decisions in microseconds without any human judgment involved. Like we've created this system that's so fast and complex that no one actually understands or controls it anymore. I'm not sure where I come down on that question honestly. On one hand, the efficiency gains are undeniable. On the other hand, there is something unsettling about the idea that our entire financial system is now run by computers that most people, including most people working in finance, don't fully understand. What's clear is that Peterffy was at the forefront of this transformation. He didn't cause all of it. Lots of other people and companies contributed, but he was one of the key figures who pushed the industry toward automation even when the industry was resisting. And his motivation, from what I can gather from his interviews over the years, wasn't primarily about getting rich. I mean, obviously he wanted to make money, but what really drove him was this engineering mindset of making things more efficient. He saw an inefficient system and couldn't help but try to optimize it. The fortune he built was almost a side effect of that obsession with efficiency. Today, in his late 70s, Peterffy is still involved with Interactive Brokers and Timber Hill, though he stepped back from day-to-day operations according to company statements. His net worth fluctuates with the stock price, but it's generally in the $15 to $25 billion range depending on market conditions. He's also become more publicly political in recent years, funding advertisements and advocacy around economic issues, especially related to capitalism, entrepreneurship, and immigration, which makes sense given his background as an immigrant who built a fortune in America. But I think what's most interesting about Peterffy's legacy isn't his wealth or even his political views. It's that he proved something important about innovation and persistence. When he first brought that computer to the trading floor in 1977, everyone thought he was crazy. The industry actively tried to stop him. The system was designed to reject what he was doing. And he could have given up, most people would have, but he just kept building, kept improving, kept pushing forward. And eventually, the system had no choice but to change because his way was just better. That pattern, the pattern of an outsider seeing inefficiency in an established system and using technology to force change, that's not unique to Peterffy. You see it with Musk and automotive and space. You see it with Bezos and retail. You see it with Netflix and entertainment. The outsider who refuses to accept that the old way is the only way. The difference with Peterffy is that his revolution happened in a market, finance, that most people don't think about or understand. You don't see the algorithms, you don't see the automated market making. It all happens in the background. But it's there, running trillions of dollars of trades every single day, and a lot of it traces back to the work that this Hungarian refugee started in the 1970s. So that's the story of how Thomas Peterffy built Interactive Brokers and Timber Hill. That's how he went from sleeping on a friend's couch in 1965 to becoming one of the richest people in America. That's how one engineer with a computer changed Wall Street forever, even when Wall Street tried everything to stop him. And that's how the foundation of modern financial markets got built by an immigrant who just wouldn't take no for an answer. Alright, so that's the deep dive on Thomas Peterffy and the automation of Wall Street. That's how one person with an engineering degree and a stubborn refusal to accept the status quo forced an entire industry to evolve, from a handheld computer on the trading floor in 1977 to a $25 billion empire today. If this kind of research and storytelling is valuable to you, if you want to understand how these fortunes were actually built, not the sanitized PR version, but the real version with all the resistance and conflict and persistence, hit that subscribe button. I release new episodes every single day, deep dives into how the world's most successful companies and people actually made it. I'm Alex Morgan. Thanks for listening to Behind the Billion.